I'm Jimi Ryan. If you're purchasing a home and you're considering a conventional or FHA loan, or you are getting an FHA loan, this is information that you really must know. So the first key difference between a conventional and an FHA loan is the interest rate. And it might surprise you that the interest rate on a conventional loan is generally higher than an FHA loan. There's pros and cons to each, but generally if you have the same credit score and it's high, it'll be about a 0.25% difference, but if the credit score goes lower, it could be a full percent difference where the FHA loan is lower. Again, there's pros and cons to each. This just happens to be a pro to FHA. Down payment. Now, conventional has lots of options, whereas FHA is more one size fits all. So with conventional, you can put down 3%, you can put down 5%, you can put down 10, 20%, you can put down any amount that you want. 3% though is the lowest, and you generally need to be a first-time home buyer for that to be beneficial. 5% a lot of times is what people do. FHA though, again, one size fits all, it's just 3.5% down. UFMIP stands for Upfront Mortgage Insurance Premium. And if you are choosing a conventional loan, this is probably one of the main reasons why. There is no upfront mortgage insurance premium on a conventional loan. FHA does have upfront mortgage insurance premium, and it's 1.75%. So how does it work? Well, it's not a fee that you pay in cash to close. It's actually the only fee that is rolled into your loan amount. So let's just say that you had a house that you purchased for $103,000, $104,000, and you put down your 3.5% down payment, and let's just say you had exactly a $100,000 loan amount at the closing. Actually, it would end up being $101,750. Why? Because this 1.75% is added at the end. So important key difference. Next is MI and PMI. So they're effectively the same exact thing. Private mortgage insurance and mortgage insurance. Private mortgage insurance is on conventional, mortgage insurance is on FHA. Why is PMI or MI good for you? There's only one reason. It allows you to buy a house without putting 20% down. It's a necessary evil for most people because not a lot of people have the 20% down. So conventional is based on a rate. It's generally between 0.2 and 1.9%. This huge difference is determined by your credit score. Credit score really, really matters when you get a conventional loan because this effectively increases your interest rate by that amount. It's just paid for separately in PMI. FHA is again a one-size-fits-all product. So it's just 0.85%, but it's that no matter what. So if you had an 800 credit score or a 500 credit score, it doesn't matter, it's just 0.85. Whereas with conventional, well, if you're under 640, a lot of times you won't even get mortgage insurance, and the lower you go, it goes up exponentially as much. Another key difference is when does mortgage insurance cancel? Meaning, when does it go away? When do you stop paying it? Well, the most right answer for conventional loans is 78% loan to value. So what does that mean? Well, you buy a house for $100,000 and you pay it down to $78,000. At that point, you're at a 78% loan to value, and your mortgage insurance goes away. You don't have to make a phone call. You don't have to order an appraisal. Literally none of that. It just completely falls off. That's going to happen naturally if you put 5% down and you make your minimum monthly payment every single month. It's going to happen 10 years, 11 months down the road, a super long time. It can go away at an 80% loan to value, which for that, you'd want to look at a refinance, and I will explain that in a different video. But for FHA, PMI never goes away. So meaning, if you have a 50% loan to value and you have an FHA loan, you're still paying this 0.85%, which is good information to know if you're choosing that because it might set you up for a different financial option down the road.